Welcome back to Shadow Fox Intelligence. Today, we're unpacking what we call the fragile risk-on regime. Look, if you're actively tracking macro, the Fed, or options volatility, this is exactly the weekly intelligence you need. We're cutting through the noise to figure out where the market is actually heading. Let's get right into it. Right now, the market is operating in a hall of mirrors, where contracting labor data paradoxically triggers an equity expansion. What's working? A massive rate relief rally built on the assumption that the Fed is pausing. But the hidden risk here is a sudden upside inflation shock colliding with real physical friction in the Strait of Hormuz. The upcoming August 12th CPI catalyst is literally going to either confirm this complacent rally or completely break the current regime. This is the Shadow Fox read for the week ahead.
Here's our agenda for the briefing. We'll hit the regime dashboard, count down the top 10 market catalysts, evaluate megacap and breadth, map out volatility stress, check the sector opportunity grid, and finally, define the Shadow Fox kill switch.
Section 1, the regime dashboard. Let's define the current market environment. So, we are currently in a fragile risk-on base case. Notice the setup we've got. Liquidity is supportive, credit is benign, and volatility is incredibly compressed. But you can feel the tension, right? Growth is decelerating and inflation is stubbornly sticky. The bull case here is pretty wild. Bad economic news, like cooling payrolls, actually keeps central bank policy on hold, which drives yields down and breeds record equity highs. But the bear case? That this labor weakness bleeds directly into consumer spending, totally shattering the valuation relief we're seeing right now. So, we're holding a medium confidence level this week, balancing a technically strong tape against some seriously fragile economic fundamentals.
Section 2, top 10 market catalysts. These are the highest impact things we're watching.
The sheer weight of these top 3 catalysts cannot be overstated. Number 1, the July CPI release on August 12th. Make no mistake, this is the regime-defining catalyst. If we see a soft print, a September Fed hold is locked in, and we get a massive risk-on environment. But if we get a hot core CPI, it revives hike probabilities, spikes yields, and crushes risk assets. Number 2, Strait of Hormuz geopolitical shocks. We are laser-focused on physical transit choke points. If diplomacy works, oil stays suppressed. But if shipping is paralyzed, we're looking straight at stagflationary pressures. And number 3, the vanishing labor force. The market freaked out over a headline drop of 23,000 jobs, but the real shock was the downward revision of 103,000 jobs from May and June. If employment concerns broaden, skew will shift so fast toward downside protection.
Rattling off the rest of the countdown, here are the highly specific signals we're monitoring. Number 4, Fed policy expectations. If the Fed shifts to a trend-dependent approach, it removes a massive ceiling on equity valuations. Number 5, tech dark pool prints. Heavy institutional buying is heavily supporting the Nasdaq. 6, UK Q2 GDP. A weak print means stagflation fears for the FTSE. 7, RBNZ inflation. Watch this for EM carry trade implications. 8, Iran conflict headlines, highly sensitive for the energy sector. 9, the U.S. earnings cluster. This is make or break for high beta cyclicals relying on the consumer. And finally, 10, Fed speakers. Any hawkish or dovish shifts will ripple through the rates complex. Section 3, megacap and breadth. We need to evaluate whether this market is actually durable or just incredibly fragile.
To figure that out, we have to look under the hood. The Nasdaq just surged an incredible 5.2%, and the S&P 500 hit a record 7,757. That sounds amazing, right? But wait, while the market cap-weighted indices are flying, equal weight participation is severely lagging behind. Sure, the Russell 2000 showed a 3.5% catch-up rotation purely off yield relief. But let's be real, the heavy lifting across the board is undeniably being done by a few top-tier growth giants, not broad cyclical participation.
The verdict here is pretty stark. Technology and AI are completely dominating institutional flows right now. So we have to explicitly state our breadth verdict: narrow mega-cap leadership. And honestly, this creates a deeply fragile setup. If economic growth fears intensify, this narrow leadership could easily buckle, leaving the broader index completely exposed.
Section 4, the volatility stress map. Let's hunt for mispriced risk in the options market.
We're seeing extreme, and I mean extreme, options flow concentrated in tech right now. Just look at the Nasdaq. We've got heavy dark pool buying and aggressive call accumulation against a contango term structure. The S&P 500 positioning is long gamma, meaning traders are just piling into this risk-on chase. But pay close attention to the stress triggers. A true regime break would require an inflation shock,
A hot August 12th CPI print would instantly shatter this complacent setup. Meanwhile, gold is seeing massive safe haven call spreads, acting as a pure structural hedge in case diplomacy in Hormuz completely fails.
It's a fascinating setup. Volatility remains contained while mega-cap momentum sustains, but upside positioning creates massive air pocket risk. The VIX term structure is in contango, which basically means near-term volatility is priced super cheap compared to future months. The market is essentially unhedged. The stress signal appears if the macro data doesn't cooperate, which would set the stage for a seriously violent reaction.
Section 5, Sector Opportunity Grid. Let's talk about where capital should actually be moving this week.
The way macro fit and catalyst risk are interacting right now tells us exactly what to do. We are pressing technology at rank 1. Dark pool flows and the AI narrative are incredibly supportive. We're also pressing precious metals at rank 2 as a pure defensive hedge against geopolitical shocks. But look at the bottom. We are totally avoiding consumer discretionary because consumer health data is just too mixed. Media is a hard avoid thanks to messy antitrust issues, and SPACs sitting down at their NAV floor, the basically dead money carrying severe insolvent risk. Stay far away.
Section 6, the Shadow Fox Kill Switch. Let's lay out the exact conditions that would force us to abandon this risk-on posture.
Evaluating our risk domains is super revealing. Rates, credit, liquidity, and FX are all compliant and flashing green. That is the engine supporting this whole rally. But check out that glaring red at the bottom, geopolitics. The physical disruption of energy shipping is a massive, unpriced tail risk. Meanwhile, macro, breadth, and policy are sitting at a cautious yellow, which is a loud warning that the foundation here isn't entirely rock solid.
So here are the exact triggers. We remain constructive while mega-cap momentum sustains on a rate pause. We shift to caution if broad market breadth deteriorates further. We go defensive if labor weakness bleeds into consumer spending, and the hard kill switch of a hot CPI print combines with an uncontained Hormuz closure. That specific combination would drive a global crude spike and literally flip the entire board to red.
So, bringing it all together, our base case is a fragile risk-on rally, carried entirely by mega-cap tech and the anticipation of rate relief. The single most important catalyst to watch is the August 12th CPI print, and the dominant risk threatening the whole setup is an energy-driven inflation shock. As our report so perfectly puts it, in the hall of mirrors where bad economic news breeds record highs, the market dances on a tightrope, stretched over cooling payrolls and restless geopolitical shadows. The big question is, will the CPI validate this fragile equity expansion, or will a geopolitical shock shatter the mirror entirely? We'll be watching the tape. This is market intelligence, not personalized investment advice.